Hello, welcome to Reality Check, where we spent a lot of time over the last month or so discussing the state of the economy, joblessness, the worrying growth numbers that are continuing to come up, lots of critics out there talking. And today, once again, the World Bank and the IMF came out and they cut India's growth numbers. The IMF, in fact, downgrading India's growth from 7.2% to 6.7% in 2017 and 18. The World Bank also saying that growth is likely to slow. Both of them did mention things like GST. However, they both also did go on to say that they think this is a temporary blip caused by GST, and I think that growth numbers are going to be lifting in the future at some point. The IMF, in fact, saying that the overall state of India's economy is quite good. Now, all of this talk has been taking place about slowing growth, including, as I said, from the IMF and the World Bank. But there's a very interesting dichotomy that's taking place. You'll have scarcely failed to notice that the stock market has in fact been rising and rising steadily. It had shot up just before the Modi government came up, touching something like 24,000 on counting day. Since then, it's risen further. Today, once again hitting 32,000. Okay, came off a little bit by the end of the day's trading, but 32,000 on the Sensex. So you're hearing all of these worrying sounds about possible slowing of growth and a poor state of the Indian economy, but the Sensex is soaring. And we've had some predictions, notably from Morgan Stanley, which say in fact that in the next 5 to 10 years, the Indian stock market is going to continue to surge. It's going to be one of the best performing stock markets in the world, touching that number, 100,000 by 2027. In the next 10 years, the Sensex could be at a figure of 100,000. What explains all of this? How is this dichotomy coming? Slowing economy, but yet a booming Sensex. That's what we're here to discuss on the Reality Check. We're going to be joined by a range of experts. Virendra Kumar is joining us from Value Research, one of the top people in India on mutual funds. Professor Arun Kumar is with us as well, who's been a sharp critic on everything that's happening in the economy, as indeed is M.K. Venu, who's also joining us, one of the founding editors of The Wire. But let me begin with a very special interview with the man who actually came out with that report saying Sensex 100,000 within 10 years and a stock market capitalization that's going to leap from 2 trillion to 6 trillion within 10 years, making India the best performing stock market in the world. Ridham Desai, Managing Director of Morgan Stanley, who really created quite a stir this week when his particular report came out and said he felt that the Sensex could be touching a figure of 1 lakh in the next 10 years. 32,000 right now. 1 lakh is a Sensex target in the next 10 years. He also thinks that the Indian stock market is going to be one of the best performers in the next 10 years, leading the market cap to rise from 2 trillion to 6 trillion. All of those really, really interesting numbers that came out about a week ago. Ridham Desai now joins us on Reality Check. Ridham, always a pleasure to talk to you. Thank you so much for being with us. First of all, the big headline number that you've spoken about right now, just like to get into it a little bit. A lakh, the Sensex at a figure of 100,000 in 10 years. It sounds really dramatic. Of course, when you disaggregate it down into the growth rate, the implied growth rate may not be, historically speaking, entirely unusual or that strange.
Yeah, that's true, Vikram. Thank you for having me on the show. So, in fact, two things that I'll say here. Firstly is that I think bulk of this 100,000 will actually happen in the next 5 years. And then, you know, how markets behave. Markets are non-linear in nature. They don't actually behave like fixed deposits, which is they don't accrue something every day. They tend to go up a lot and then they fall. So bulk of this 100,000 I think is happening in 5 years, and then probably we get a bear market because the market price is in a lot of growth. So that's one thing. And second thing is you make a very relevant observation. The implied growth rate in stock prices is about 12% based on this forecast, which is actually less than the 16% that the Sensex has given us in, say, the last 30 years. So yeah, growth returns are slowing down for many reasons. Domestic factors include inflation rate, which is lower, and therefore interest rates in India are lower than they used to be. And globally, I think growth rates are lower. We're no longer in a tearaway global bull market, either in terms of economic growth or in terms of equity returns that we've seen in the past 3 decades. I think that ended with the crisis, in 2008. So it's a more tepid world, and therefore, India is not a small economy anymore. It's already one of the top 7 or 8 economies in the world, and by our report and our forecast, India will be a top 3 economy in the world. So it's not a small place anymore. It cannot really deviate from global returns. But yeah, you're right in your observations, and I do think that India could end up being one of the best performing stock markets in the world over this time.
Right. So India will be one of the best performing stock markets over the next 10 years. But just to re-emphasize that point we were just discussing, and let me make sure that I get this correct, it sounds really fantastic to say Sensex 100,000 by 2027, right? It's a big landmark, and it's something to really talk about, tripling in the next 10 years. But this is, as you're pointing out, slower than what has actually been achieved over the last 30 years, which in a sense just indicates how strong the stock market has been performing for the last 20, 30 years in India.
That's true, but Vikram, as I also added, that bulk of these returns will come in the next 5 years. So actually, if you look at,
I just want to take you up on that rhythm, because that phasing is one of the things that actually, I raised has raised some eyebrows, certainly mine, because some would argue that if the economy is slowing down right now, it's at 32,000 right now. We've had a spectacular bull market, if you think about it, from 2013 to now. Last 3 to 4 years, market has gone from what 14,000 just before the Modi government came in to 32,000 right now. It's virtually doubled in 3 to 4 years. Some would say with growth slowing down a bit right now, with some of the worrying signals out there, who knows whether global markets are overpriced right now. There could be war with North Korea. Who knows what's going to happen. So some people would wonder whether the next 2-3 years are going to see a slowdown or a bear market, and then the returns pick up. Why is it that you don't think that's the likely scenario?
See, from an India perspective, Vikram, I think a lot of work has been done in the last 3 years. When this government came into power, it inherited a saving deficit and high inflation. And bulk of the last 3 years has been spent in fixing that. So we've lifted real rates into positive territory, the current account deficit has come down, and inflation rate has come down. That, such things usually cause pain to growth. So the fiscal deficit has been brought down, for example. And that's what we have suffered in the last 3 years. Now I think we have set the stage. And on top of that, if I may add, we had the demonetization blip end of last year, and then we had the GST execution, which is not a small thing. It's probably one of the biggest tax law changes in the history of the world. So with all this that has happened in the last 3 years, no wonder the economy has not done as well as we would have expected it to. But I think this is all in the bag now. The market is a forward-looking animal. I think it senses that growth is turning. And I suspect actually India's growth rates would have turned sometime last year itself, but for the fact that we had the demon blip and then we had GST to be executed. So the economy, I think, has troughed out, and we should see better growth rates in the next 12 to 24 months. The market looks forward, and prices in some of it, not all of it, because the market also doesn't know for sure whether growth is turning or not. The good thing for India is that the global economy is on a strong footing right now, and it seems we're entering 2018 with that type of a global environment. So it looks actually much better for India in 2018.
But Rhythm, if I could just play devil's advocate out here, when it comes to India itself, there are a lot of people saying it's possible that it's short term. The World Bank, IMF, both of which downgraded India's growth just today. Those numbers came out. They did say that GST has caused a hit, although they did say it's a temporary blip. They think that things are going to bounce back next year, just as you said. There are others who think that the damage to India's economy is bigger and is stronger and is not going to be repaired that quickly. You don't seem to agree with that position. There are a lot of people who are saying there's a lot of pain out there, especially in rural India, not entirely being reflected, and it may take longer for growth to come back. You don't accept that?
No, I don't. I think we've already suffered that pain, Vikram, in the last 3 years. So we have taken this time to consolidate the economy. And what you have to look at is, say where is inflation? Where is real rate? Where is the current account deficit? A lot of these factors which were going haywire in, say, 2012, 2013 have all been brought under control. So I think the set has been staged, the stage has been set for a recovery. And in fact, we can see the signs. You look at consumption growth in India, it's actually quite strong. You look at government capex, and we look at public spending is at all-time highs. It's at 9.5% of GDP, and that's the counter-cyclical spending that the government has done on investments. You look at exports, they are recovering. The only thing missing And a lot of people are overly focused on this is private capex. But private corporate spending comes with a lag. It doesn't lead the economy. Consumption and government spending do. So we have already started doing that. I think in the next 6 to 12 months, you will see private corporate spending come back as well.
Okay, so a strongly contrarian view there from you, Rhythm, to what we are hearing from many people at the present point. And of course, we'll have to wait and see. Are you right? Is the economy going to recover? Or are there more serious issues there, such as that NPA burden, such as the cost of compliance, which is still an open-ended question as to how long that will actually take to get sorted out. On the global side, though, Rhythm, just wanted to ask you, there is a view that global equity markets are also really expensive. If you look at some data, price earnings in many of the developed markets are probably higher than any time they've been since 2020 or the 1929, just before the depression, or 2000, just before the dot-com bust, which again is making people wonder whether we are in a bubble.
Yes, Vikram, but you have to see all of these things in the context of other asset classes. So for the Western world in particular, interest rates are so low. The only reason why things could actually go wrong is if inflation comes back. And that's the debate right now, if you ask me. Is inflation coming back? If it's not coming back, interest rates stay low, then the P multiples remain elevated, because that's how equities trade. In fact, our house view is that I think the global equity markets are okay for the next 6 to 12 months. There doesn't seem to be anything out there to worry us. But the thing to worry about, or the thing to keep an eye on, is inflation. I'm not talking about India, but in the US and in China and in Europe. And if inflation comes back, then we could have a bit of a wobble in global equities.
Okay, so if you're somebody watching this program just before Diwali and saying, so should I go in and invest in the Indian market or not at 32,000, you're hearing all these scary stories about the economy. What would your advice be? Go inside there, get fully invested, wait for dips, or eye that magical 100,000 number that you've been talking about?
No, see, Vikram, for your audience and for bulk of the investing population of this country, the best way to buy equities is to systematically commit funds at the end of every month out of your income, and just do that month after month, not worry about where the Sensex is, not worry about what the macro is doing. Equities is a long-term asset class. It eventually figures itself out and delivers solid returns if you don't try to time it. The maxim I use is, okay, spend time in the market, don't try to time it. And all these conversations about trying to time it, let's see if there's a 10% correction and then I'll put money to work. These things don't work in practice. In practice, what works is spend time in equity markets and eventually they figure it out for you.
Okay. Last question, Rhythm. At the end of the day, if you had to give your own gut feeling on this, that figure of 100,000 that has grabbed the headlines in 10 years, likely to be an underestimate or an overestimate? What's your own gut feeling?
We have a bull case of 130, but we also have a bear case. But again, I'll reiterate the point that I made at the start of the program, which is that
what's your bear case?
I think the bear case is that we go down. We get down to around the 60,000 level. So the market only doubles in 10 years, which obviously means it's a very poor returning stock market. So there is a wide range, and that's the problem of forecasting for 10 years, because there are so many imponderables that I cannot actually plug into my forecast.
Okay.
But the point that I'll make before we end this is what I made at the start of the program, which is I think bulk of these index returns may come actually in the next 5 years. So you may not have to wait for 10 years to achieve them.
All right. Don't have to wait for 10 years to achieve this. Bear case 60,000. The base case is 100,000, and there's a bull case for 130,000 on the Sensex. So that's one of the reasons, I guess, expectations of things like that is one of the reasons why that dichotomy that we began by discussing, soaring Sensex, but the growth rates are down right now. One of the possible explanations, you're eyeing that big growth prospects in the future. Rhythm Desai, it's such a pleasure having you on the program. Thank you so much for joining us.
Thank you, Vikram.
All right, so this entire dichotomy about a buoyant Sensex and a slowing economy. The Sensex did correct a little bit towards the end of the day today, but the fact still remains it's at 32,000 level. We heard what Mr. Desai actually feels about this, and the long-term future is there. What else could possibly explain the dichotomy that we are seeing. Some more. So let's just turn to our very special panel. Joining us, Dhirendra Kumar is with us, the head of value research. I can tell you, nobody in India knows more about what's happening in mutual funds and, by extension, the stock market than he does. M.K. Venu is with us as well, and Professor Arun Kumar, senior economist. Dhirendra, if I can just start with you. Let's try and understand why it is happening. Now, one of the factors, as Rhythm Desai has been telling us, is Sensex could be heading for 100,000 just by normal growth rates. So India is going to grow, it's going to happen. That's why money is coming into the equities. You have another view also that there are some technical reasons why the Sensex and the stock market will continue to do well.
Yes, if you look at the dynamics of flows into the market, we have some very fundamental things happening. NPS is turning big. 10% of NPS money, which is a mandatory statutory
national
pension system, and that is mandatory for all state government and central government employees. 10% of their salary is deducted. It is matched by the government, and that money goes into the is getting invested. 10%, approximately 10% of that money finds its way into the market, and that is a ever rising money, and it's a different kind of money. This money comes and stays there for 30 years. 35 years till the person turns 60.
So it's not like some of the money which used to come to the stock market, which is hot money. Market, people are buzzing about it, people are buying shares in, on basis of tips,
likewise,
and then they pull it out. This is long-term money.
Employee Provident Fund Organization, it has started investing money in the Nifty ETF. It's the lowest cost ETF, and it has turned 30,000 crore. It has become India's largest equity fund in no time, in about a little over a year's time, and it is going to get bigger. It's going to get bigger because that money has been mandated. It has gone up from 15 to 20% now, and all the incremental money going into EPFO. The SIP flow that has started coming into the market, that has gained its own momentum. I think it's close to 6,000 crore. It is gradual. Investors' experience is so phenomenal there.
So if I can just add that up, investors putting in 6,000 crores a month into SIPs, that's what, nearly 72,000 crore rupees over a year?
And money to
wow,
stay.
That's a lot of money.
Yep.
30,000 money coming in from the EPFO, or more, maybe more than that.
Could be more.
Plus money, 10% of all NPF money. All of this money is coming into the equity market and is likely to stay.
Yes.
So you're saying this is one of the reasons why the Sensex is going to be strong and may continue to be strong.
Of course, companies have to do well. If companies struggle, companies go bankrupt, there's no such guarantee. But, this is one thing which has changed substantially. It wasn't so 2 years back. It wasn't so 3 years back. And if companies do well, if companies make more money, things will get pricey.
Okay. M.K. Venu, let me turn to you on that. So this particular factor helps us in answering the question. So yes, valuations may be rising, but there's a lot of money, long-term money, now moving into the Indian stock market. So it's very possible that whatever the growth levels are, the market will continue to rise.
See, Vikram, I have a slightly different way of looking at it. I'll give you a very interesting bit of data which I read about in Business Standard. In the last 3 years, Vikram, 3.5 years, the market has gone up some 66% but the earnings per share of the Nifty companies have gone up less than 5%. So I see this as a problem because I think our markets are in a bit of a bubble territory, and it is really not reflecting the top line growth of either the companies or forward-looking earnings, either forward-looking earnings, or is it reflecting the real state of the economy? All other parts of the world, GDP is growing, employment is also growth is picking up.
GDP in India is not declining. To be fair, Venu, GDP is not declining in India. It's growing. The rate of growth may be coming down a bit, but GDP is still one of, we're still one of the fastest economies in the world.
That's what I mean. Rate of growth is declining. Yeah, GDP. That's why I said GDP growth rate is declining. I'm not saying GDP declining per se.
Yeah.
So Vikram, we are actually according to Ruchir Sharma, we are sitting out the global recovery at this moment. So I don't know how to interpret this market. Markets going up.
We've just got one of the possible explanations from Dhirendra. Professor Arun Kumar, just to touch on this entire issue of what the IMF has said and the World Bank has said, both of them seem to be saying they've cut the growth rates right now, but they both seem to be saying it's a short-term phenomena. It's going to eventually bounce back, and both of them seem to be saying that long-term GST will be good. Do you agree with that?
No, the point is the IMF and the World Bank do not collect independent data. They are dependent on the government data itself, and that data we know doesn't take into account the unorganized sector at all, and that's 45% of the GDP. So my own take is that the rate of growth is close to 1% at this point of time. So that's the real worry, that the rate of growth is slowing down and the impact of GST and demonetization is continuing because capacity utilization is very low and investment rate is very low in the economy, and these are sure signs that actually the slowdown will continue. You have seen the credit offtake has actually gone to a historic low, where in July and August it had turned negative, which has never happened before.
Dhirendra Kumar, let me just turn to you. On that aspect of it, that look, it's a speculative bubble in some sort. That's the first question that people ask, and that's why when today the Sensex hit 32,000, there was some selling after that. Some people feel, oh my God, it's now rising a lot and it's stoppish. The inflows that you're talking about, now theoretically the EPF money and the NPF money unlikely to move too much, but certainly the SIPs could reverse reasonably fast. People are putting in all their money through SIPs because the market is going up. If the market comes off 1,000, 2,000 points for whatever reason, it's very possible people will stop the SIPs and in fact start withdrawing the money.
Not really, on the contrary, I think that, individual investors have behaved very differently in the past. Individual investors wait through all the correcting times to break even with their money. Investors don't look at their money. If somebody invested 10 rupee in an infrastructure fund in 2008 and he saw his money go down by 50%, they have waited for 5-6 years to get out of it. Psychologically it gets very difficult. Then the whole arithmetic of SIP is very different. You are averaging your investments and your experience is generally not disappointing, because even a rising market or even a speculative market comes with a lot of ups and downs. So on a month-on-month basis.
That discipline, which is what all stock market experts and others have said, is when the markets are down, you should actually continue investing. If anything, you should invest more. Are Indian investors appreciating that?
Yes, in fact, the only case for SIP is not that, we have this great campaign going on, which is mutual fund sahi hai, but, besides that, you have a word of mouth. People are saying that I did this, I benefited, and this is what it stands for, and it was done with great simplicity.
Okay. So, Venu, let me just touch you on that point. I mean, just as with your economic hat on, theoretically, that's the whole logic of SIPs, that even if there is to be a slide or a correction, markets run ahead of itself and it corrects. Logically, that's when people should come in and invest more money, because that's what the principle of SIP is.
For the reason that Dhirendra just cited, it is Vikram, if people are getting pushed into mutual funds and generally to the markets through mutual funds, because other avenues are down, like real estate is really down, and real estate, earlier people had 100% confidence that real estate would give them at least average 20% a year. Now that confidence is gone. And typically real estate recoveries, Vikram, are very, very long drawn, and it's going to take 2-3 years for real estate to recover. So people have moved into the markets. So next time, when and if it is not supported by a fundamental growth in the economy in general, Vikram, what will happen then is the foreign institutional investors will start reallocating funds among emerging markets. And as I told you, if India is among the laggards of all the emerging markets, we are among the 25% not growing as much as the 75% which are growing, then funds could shift. So that could become a reason for our markets to kind of taper off a little. That risk remains.
Professor Arun Kumar, we're nearly out of time. Just want to get your final take. Are you at all concerned that there is a bubble in the stock market? Because most experts looking at right now are not seeing the bubble sort of signs.
When the P ratios rise, that is the sign that the bubble is building up. Now the question is, at what point does the bubble burst? And there can be many factors for when the bubble bursts, not one or two factors. For instance, Venu has pointed out that if FIIs begin to pull out and that begins a downturn, then that could accelerate, because stock markets are based on expectations. So it's really a question of what are your expectations of future, and the government has to really worry about how to revive the economy. And when the government takes certain steps, one of the steps could be a rise in the interest rates and fixed deposits, etc., to try and get more money in. Another could be a rise in the fiscal deficit, much sharper than what was talked about. Expenditures on rural areas, and some of these can change expectations. And when expectations change, that's when the bubbles burst.
All right, fine. Well, thank you all so much for joining us. Just a quick line from you. Is there a bubble, you think, or no?
I don't think so, because there could be bubble in the narrow part of the market, and that also has corrected.
Maybe the stock markets are seeing something that a lot of the economists and others are not. They're betting on the long-term future of the Indian economy, as Rhythm Desai was saying. Maybe there are technical factors that Dhirendra was saying, a lot of money flooding and a lot of liquidity there in the Indian markets. Is it bubble territory? Probably too soon to say that right now, but an interesting phenomena that we should continue to take a look at. Leaping Sensex, crouching economy, perhaps is the best way to sum it up. You're watching Reality Check. We'll be back tomorrow.